CNBC TV18.
Hello, welcome to News Center. I'm Parikshit Luthra. What was being anticipated for a very long time has finally happened. In a surprising move, the Reserve Bank hiked interest rate by 40 basis points, taking the repo rate to 4.4%. RBI Governor Shaktikanta Das attributed the rate hike decision to geopolitical challenges and rising inflationary pressures. He said recent GDP releases suggest that global economic recovery is losing pace and global growth projections are revised downwards for 2023. He, however, added that India's external sector has remained resilient amidst formidable global headwinds. The RBI's rate hike comes at a time when India's trade deficit widened to over $20 billion in April, rising by 31% over last year. While exports jumped by over 24%, imports were up by over 26%. How will RBI's decision impact India's trade sector? Joining us right now are Aditi Nayar, Chief Economist at ICRA, Mahesh Desai, Chairman of Engineering Export Promotion Council of India, Ajay Sahai, the Director General of Federation of Indian Export Organizations. Aditi, if I can begin with you, the MPC voted to increase the repo rate. What impact do you think this is going to have on the economy?
Thank you, Parikshit. Well, the MPC was eventually going to start increasing interest rates, and we had expected to see a stance change along with a 25 basis point repo rate hike to kick off the process of policy normalization in the June meeting. So what we've got firstly is an off-cycle decision. Basically by at least 1 month. Also, what we got is the rate hike, which is a little bit higher than what we were expecting as the first stage from the MPC in June. So clearly, coming with a CRR hike, it's a complete pivot towards inflation management and the anchoring of inflationary expectations that the MPC has delivered today. And they made it very clear that going ahead, they're going to be very nimble-footed and it's going to be more data-dependent. So overall, if we look at the rate hike, I will say it's an advancement and it's a slightly bigger first stage than what we were expecting. And going ahead, I would expect that over the next three policies, which is June and August and September, we could possibly expect another 35 to 60 basis points of rate hike, taking this part of the cycle to 75 to 100 basis points. And then I would expect there to be a fairly long pause for a reassessment of growth. All said and done, growth is unlikely to be super strong in the next 12-month period, and therefore after some amount of rate hikes to re-anchor inflationary expectations, I do expect that there will be a reassessment of the growth situation, and possibly in the second stage of the rate hike cycle, we could expect another 50 basis points. Now, whether that comes in Q4 of FY23 or in Q1 of FY24, I think that's something that remains very data.
All right. Thank you for that quick update, Aditi. Let me also go across to Ajay Sahai. Mr. Sahai, we also heard the RBI governor saying that global economic recovery is losing pace. Looking at the announcements made by the RBI governor today, what impact do you see on India's exports?
In fact, you have rightly said, if you look into the WTO forecast, in the recent forecast, they have slashed the global trade growth from 4.7% to 3%, which is around 50% sharp decline. And I personally feel that in many of the segments, we are seeing the inventory building up, and with that, demand may slow down. So as of now, exports are doing very well. We have seen 24% growth in exports. And of course, people are talking much about the rising imports also. But when I'm looking into the data of non-oil, non-gem and jewelry exports, it is not so much. Of course, on non-oil imports, we have around 12.3% growth in export, 9.9% growth in imports, which is manageable. I think the lot of discussions on the trade deficit is happening because it has gone by around 30%, but I think the real culprit is the crude, because in the crude alone, we are spending around $9 billion more than what we spent in April 2021. So far exports are concerned, we feel that as of now, for next 6 months or so, we may see export growth momentum, but the demand with rising inflation may take a hit, and that is something which is worrying us and which is quite reflected in various assessments made by international agencies also, and RBI has taken cognizance of that as well.
Right, you're saying you will see export growth momentum over 6 months, but there may be a drop in demand as well. Mr. Desai, coming into you, we saw an uptick in engineering goods exports. Looking at all the announcements made by the RBI governor, what impact do you foresee on the economy, especially when it comes to the engineering goods sector?
Well, I have a very positive outlook for coming few months for engineering exports. We'll be able to maintain the momentum of growth for coming 4 to 5 months. But the increase in repo rate by the RBI may little increase our cost. But ultimately, the government also gives us subsidy, what is known as interest subvention. So that will be also there. And we may again go to government to increase interest subvention. So it may slightly offset. But according to Engineering Export Promotion Council and our own study, that there will be a good, we'll able to maintain the momentum for coming few months. But after few months, there are so many other factors, geopolitical, war, inflation, increase of repo rate, increase of rate by United States Treasury, and so many other factors. So that also have to be taken into consideration. That's
Right. Coming back to you, Aditi, when it comes to the trade deficit that we have seen in the month of April, it came to a high $20 billion. Do you foresee the trade deficit to continue at this level over the next 2 months because of the crude oil imports and global crude prices, the coal shortage?
So, Parikshit, so I want to go back to something that Mr. Sahai mentioned as well. If we compare the trade deficit between April 2021 and April 2022, the increase is entirely on account of the net oil imports. For the non-oil import or sort of the non-oil trade deficit, it's remained steady, but there's been a shift in the composition. So we got a plunge in gold imports in April 22 compared to April 21. But the non-oil, non-gold imports have gone up, and that is basically a fallout of the higher commodity prices and the impact of the global tensions that we've seen on the supply side, as well as the, to some extent, what's happening in China. So going ahead, the way we are looking at it, we expect that the merchandise exports growth is probably going to be in the range of 8 to 10% in FY23, but imports are probably going to grow by closer to 14 to 15%, and that's partly because the oil price is going to remain elevated, although it may decline in the quarters ahead, particularly depending on the timing of easing of the geopolitical conflict. But we expect import growth to be higher than export growth in FY23. And I do expect that in a majority of the months of FY23, we're likely to have a trade deficit which is higher than $20 billion.
Right, you're saying you expect a trade deficit higher than $20 billion for most of the months in FY23. Coming back to Mr. Sahai. Mr. Sahai, looking at the export basket and the current geopolitical challenges, which are some of the areas of opportunities, your outlook for the next few months?
In fact, we are doing extremely well in sunrise sector of exports and some of the labor-intensive sectors of exports. Particularly if you're talking about the electronics, chemicals, both organic and inorganic chemicals, ready-made garments, engineering goods, we have done extremely well. And our sunrise sector becomes important because they basically belongs to where the major exports or major global imports is happening. So once you are increasing your exports in those segments, you will be continuing to have a growth momentum. That's why we feel that PLI scheme is one which will help us to build the growth momentum, because today, if I'm looking at the electronics, electrical machinery, automobile, these three segments put together account for roughly 35% of the global trade, with a whopping figure of around $6.7 trillion. And in that segment, our total share is less than 1%. But all these segments are covered under the PLI scheme, and we are seeing very good result of the PLI scheme in mobile exports, and probably the electronics will join the fray. So these are the segments where we will do extremely well. It is very encouraging that engineering sector for last 14 months or so are showing continuous growth in exports. Recently only we have seen apparel sector picking up. India is now gradually integrating more through the FTA, which also we have carved out one with UAE, which is now operational. Probably in next 2 to 3 months time, Australia will also be operational, and maybe by October we may see with UK also. So these kind of the market access will help us to build on exports also. I think one of the reasons for rising trade deficit is also the fact that companies are having a larger inventory at their disposal, and that to some extent speaks of increasing imports of electronics and chemicals, which is reflected in the recent figure, because most of these imports are coming from China, and with a lot of uncertainty in China, companies may be preponing their imports and they are having a little larger inventory. So for these products, I personally feel that the import trend may slow down, but I entirely agree. It all depends what way the inflation will work, and if the prices remain buoyant, we may have to live with a larger trade deficit. But if we are seeing some somber impact with the inflation under control, we may see a little less trade deficit.
All right, we're going to take a short break, but we'll request all our guests, Mr. Desai, Mr. Ajay Sahai, Aditi, to stay with us. We'll be right back after a short break. Welcome back. You're watching News Center with me, Parikshit Luthra. I'm in conversation with Aditi Nayar, Chief Economist at ICRA, Mahesh Desai, Chairman of Engineering Export Promotion Council, and also Ajay Sahai, Director General at FIO. Thank you very much for being with us. Mr. Desai, coming to you right now, looking at high logistics costs and also high commodity costs and shortage of commodities as well, what is the kind of pressure that will be there on the manufacturing sector going forward?
I agree with you. There's a lot of pressure on our manufacturer, particularly to our MSME sector, which contributes sizable amount of direct or indirect exports. But we are also seeking some help from the government to offset some of the cost. Ocean freights, I don't think will come down in near future, or it may go northward also. The other pressures what we face, that ocean freight and other logistic pressure, last mile connectivity to the port, then availability of Concord, and so many internal as well as external pressures are there. Even though the goods are ready with our godowns, but it doesn't reach to the seaport and it doesn't reach to our buyer in the foreign seaports. So these are the pressures we are working with. But with all these pressures, I am very hopeful that coming few months we will definitely have buoyancy in our exports, because our MSME is doing extremely well. They have joined the bandwagon. They have also joined national as well as international supply chain with an acceptable quality product. It's a good feature for our engineering exports. Pressures are there, I agree, and we have to manage those pressures. Maybe our profit margin will squeeze further, but that, let me tell you, at this stage, our exporters are full of books. Their books are full of export order, and more inquiries are coming in. So we are hopeful of good. Other point for imports, you see the entire import of raw material and other things, that's part of it. Sizable part of it is also for export promotion, because we use it in our engineering industry. We add labor and cost to it, and then with added cost, we export. So there is certain amount of import for exports. What I fear is that import of cooking oil, which will play a major role for our inflation in our coming months. Thank you.
Right. Okay, thank you. Thank you for those comments, Mr. Desai. Aditi, coming back to you at this point, focusing again on the statement by the RBI governor, the announcements that he made with regard to the Monetary Policy Committee meeting that took place. Tell us about the key sectors of the economy that are likely to face an impact in the coming few weeks and months as a result of these announcements.
See, a couple of things, like I was saying earlier, broadly the expectation that rate hikes are going to take off, that was already there. So the timing is the surprise that it's been advanced, it's been off policy, and the quantum is a little higher than what we were expecting. But otherwise, most of market participants were probably well prepared that rate hikes were going to come in sooner rather than later. What we've seen today, the immediate reaction is that the bond yields have gone up. The 10-year bond yield went up by almost 25 basis points. Before it came down a little bit during the day. And looking ahead, depending on what the Fed does tonight, we do expect that tomorrow we could see the yield moving up further. We had expected the 10-year yield to reach a high of about 7.5% in the first half of this fiscal year. But if we get a slightly hawkish Fed tonight, I guess that we're going to be at testing 7.5% tomorrow itself. So overall, in terms of the repo hike, we also expect that it's going to get fairly quickly transmitted to lending rates, especially now that the CRR has been hiked alongside, and there is an indication that we're moving from ultra accommodative to accommodative. So there could be further measures, maybe through another round of CRR increase going ahead, which will also lead to the liquidity surplus being reduced over the period course of FY23. So overall, I would say whether we look at the bank lending rates or we look at the bond market yields, both are likely to go up. And that is something that has implications throughout the economy. So it's not any specific sector, but overall, borrowers will have to deal with interest rates being higher. So that's a global trend as well. So that's nothing different. I mean, we are facing higher inflation just the way that most global economies are as well. And that's the way that the cards have played out for FY23. Specifically, as far as investment is concerned, we did expect that there will be a dip in capacity utilization in the current quarter for two reasons. One, seasonally, Q1 tends to be the weakest quarter for capacity utilization. And secondly, we also expect that with the way that things are moving, dynamics in terms of higher inflation, but an opening up of the economy and a normalization of behaviors, we expect that demand is going to shift towards services from goods as opposed to what we've seen in the last few years. So capacity utilization is something that we expect will rise gradually to 75% by the end of this calendar year. And with interest rates going higher, perhaps the private sector will be just that little bit more cautious in terms of now saying capacity expansion now that it's clear that we've pivoted to managing inflation and inflationary expectations from an overarching focus on growth. So I think there could be a little bit of caution that comes into the private sector for this capacity expansion that we were expecting from December onwards. That might get a little bit delayed, but we're hopeful that with government revenues surprising on the upside month after month, that government capex is going to kick off quickly and really fill in that gap.
All right, Mr. Sahai, if I can get you in at this point, as the RBI governor was also talking about, this is the time when we're looking at geopolitical challenges. There are shortages of edible oil, sunflower oil as well. Do you think these will add to India's import bill in the coming months? Of course, there will be a demand to import coal, demand to import oil as well. Of course, those items are there, but there will be other goods which will contribute to India's import basket.
In fact, we are seeing the pressure on edible oil mainly because earlier the supply from Ukraine was not happening. Then Indonesia put a ban on that. Little challenges on the inflation front will continue. Whether the geopolitical situation results in better export opportunity for India, we would come to know once there is a ceasefire. What kind of sanctions will be on Russia, one has to see. what entities are put under sanctions, because we are getting a lot of inquiries right now, not only from Russia but from the European Union also, where demand for steel, some of the cereals and chemicals are coming to India. So whenever the situation normalizes there, we have to see what kind of opportunities are created. But I entirely agree that war is not good. It is supposed to affect the global growth in a big way, and it will add to the uncertainty. Another worry for us is that a lot of countries who are not affected with the war, now they are having huge foreign exchange shortages because they were totally dependent to a large extent on tourism earning, and now with the restrictions still coming into play, they are having huge shortage. We have seen that happening in Sri Lanka, though maybe for other reasons also. About Nepal has also put a lot of restrictions. There may be many more countries. So what kind of shape will be in place after 6 months or so is something where we need to ponder, we need to revisit our strategy. But as of now, the still orders are flowing to India because China has slowed down. There are a lot of restrictions coming into China. But I think as we move along, we have to take a call, revisit our strategy, and to see what needs to be done for the next 6 months or so.
Right. Mahesh Desai, coming to you, in terms of the FTA agreement that we've signed with countries like Australia, with the UAE as well, how will this help drive India's export further in the coming months?
Yeah, coming to FTA with UAE, United Arab Emirates, it has been operationalized from 1st of May. And what the input we get from Dubai as well as other quarters, that there's a continuous inquiry from those quarters in Dubai for exports to other countries. Now, Indian goods can go zero duty to those countries, and from there, because of availability of shipping connections, air connections, and financial markets. So,
all right,
there is good demand for that.
Mr. Desai, I'm sorry, we've run out of time. Unfortunately, we've run out of time. I'd like to thank Aditi, Mr. Desai and Ajay Sahai for joining us on this program to give us their view on the decision made by the MPC, the announcement made by the RBI governor, also on the trade data. We're getting an exclusive